when we are working with respect to this type of question, they will ask more than calculations. What is our understanding? That's very important. More than calculations. Calculations matters very less. Even it is not, I will not say even 30%, it is going to be only 15%. But the perception, how it influences debt, equity, what is the future impact, how you are going to have a future strategy if you are taking the current decision. That's what it talks about, technically speaking. And more importantly, when we do the things, how much we are going to raise finance, from which type of what are the different types of sources of finance. That's what it talks about. If you are not told the value in the question, the best way is estimating the value by using the formula. See, now what happens, keep it, these are the things which matters a lot. You make your own assumptions. Nothing will happen. You put as an assumption and you carry forward the things. They will give you marks. You put your assumptions, nothing is there. Reasonable assumptions, that's what it says. Present value of the receipts to the lender, interest and redemption. Now, little bit, when we are doing this, I'm not saying that you have to change that platform. Little bit when we are talking in terms of financial instruments, okay? I'm not talking about the rules, okay? Keep it in mind. I'm talking about the way we are, when we are talking about the debt. What is the concept? We are going to convert the debt into the present value. Okay, we will convert the debt into the present value. These are the things that matters. Okay, present value of the receipts to the lender, not for us. Okay, what is the present? Because we are borrowing the loans. Okay, we are borrowing the loans from the finance provider. Okay, and we are paying it over a period of time. That concept we have to make it clear that how it will work. It is discounted at the lender's required rate of return. These are the things we can make an assumption. The valuation of debt is in more. The valuation of debt is more important. Okay, valuation of debt is because, as a matter of fact, the more strategically you plan, the more you rely on debt. I'm saying you means the company relies on debt. They structured the debt in a very sophisticated mechanical manner. The company, this is what we are talking. The company in the previous illustration now believe that earnings of the planning horizon will be earnings after the planning horizon continue at the level 3 year 3 level into perpetuity, or grow at the 9% into perpetuity. See, what will happen? Everywhere you will plan. Okay, when you are planning, I told you this is what we are doing. I'm telling you the actual questions, how we are going to work it out. We will plan maximum 5 years, or we will plan for 3 years. Fine, that's not a question of debate here. If we are saying go with the information given, if it is going to be a continue at 3 level and perpetuity till level 3, we will discount. Okay, till level 3 we will discount. After level 3, whatever the cash flow will be there, 1 plus r to the power of 3. This what we will do, we have the formula. What is the formula? See, with growth and without growth. If it is without growth, forever. Okay, it is without growth forever. Is it forever? Without growth. Okay, what is the formula for growth without growth? C divided by R, forever. If it is with growth, what we have to do? We have to do C divided by R minus G. Is that C divided by R? This is what it says. Is that whether they are going to have the continued level 3 without growth, and if it is going to be with growth. Recalculate the current value of the firm. Always keep it in mind. We are talking about the current value of the firm, and also we are calling the value of the equity. These are the basics, and everywhere it will matter. And if we take into consideration, this matters 1 mark each. This is related to the things as such. Now, what they say, keep it in mind. If you have done fine, even I will just go through the basic concepts. Okay? You have the free cash flow, FCF. They will give you, okay, FCF. Yeah, this is the language of financial management. They are talking about, see that from year 3 it is till year 3 it is 6.5, and we are estimating that from year 4 onwards it will be 6.5. Now they will present value, factor, fine, all the things. Now we are taking the total value of the firm minus value of the debt. It comes to value of equity. It is VE. Assuming that from year 4 onwards it will be the same value for perpetuity. If they say that it is with growth, okay, with growth, definitely what will happen, we are going to take into consideration. What are the things? We will take into consideration here how much is there. Is it? See, year 4 onwards, how much is there? 6.5, okay? 6.5. Here they have mentioned they mentioned something called as inflation. Inflation plays a very key important role, okay? We have to always focus on inflation. Where they have mentioned inflation? Where is the inflation factor?
The growth?
No, inflation is how much here? Here it is 0.9%. Okay, yeah, fine. 1 second. Here I think it is growth. Yeah, grow at a 9% perpetuity. Sorry, it is a growth. Is it right? How much they are growing? It is going to be growth at a 0.9%. Is that? See the thing. What they say? They put it at C1. See if you remember. Is that this is related to dividends? Is that why I am giving the reference? I am giving the reference so that you should have. Is that D1 plus G R minus G? Okay, R minus G. Yes. If you take into consideration, I am just giving you a reference. If you take into consideration with respect to the cash flows. Okay, with respect to the cash flows. Whatever the cash flow we are getting, is that C4? Is that 1 plus G? Okay, C4 1 plus G divided by R minus G. The same formula we are using, but we are only changing the context in which we are using. Okay, so they will mention very clearly if it is with growth or with this growth. And we have to do this by any way. This is no other option. They will ask you what is the value of equity, what is the value of the firm, or what is the value of equity. Is it okay? Take everything into consideration. Is that 54126? Okay, 54126. We are taking 2273. Where is 2273? 2273, 37.17 and 482 minus debt value. Is it? Minus debt value. Take everything into consideration. I think they have done individually. Okay, they have done individually. Okay, they have done individually. Okay. And this is the part of every question. The basic first step in every question will be only this only. Okay. Now, coming to the things, okay, calculating FCF, okay, the FCF for accounting. When appraising individual projects, invest fund could easily be estimated. However, identifying the cash flow for the entire company or business is much more complex. Is that if it is going to be for a single unit, it will have much more complication. What are the things we will cover? Work it out. Say that you will have. We are not supposed to do this, but it is a part of our exercise. Okay, it is part of the exercise. Relevant things have been mentioned on the right hand side. Okay, relevant things has been mentioned on the right hand side. See, we are this is a normal procedure where we are talking about the calculating of see what we will do. The difference I will tell you. The difference is we are in the previous cases till now we calculate cash flow and we will discount it. Okay, we will discount it. Now what we are doing, we are not working on the cash flow. We are working with the free cash flow. Is that there are two things are there. FCF is there, FCFE is there. Free cash flow is there, and free cash flow to equity is there. It's very interesting. You will find how we have to evaluate what are the when a project comes, when a client will come and submit, how they have estimated and how it is going to be evaluated. Okay. Now, what is the difference between FCF and FC cash flow and FCF? In the cash flow, automatically we will stop here. That is why it is an operating cash flow. In the free cash flow, we will less replacement any non-current assets, any incremental non-current assets, and any incremental non-working capital. Any additional incremental we will deduct it, needed in order to continue operation at the current level. We have done, if you remember in chapter 2, what we have done, we have added working capital. Okay, we have taken into consideration the working capital. First in order to calculate the free cash flow, what we have done, we have deducted the working capital over a period of time every year, and in the last year we have added working capital. Working capital is only a supporting one, that's all. We are not talking about anything else more than that. Are you clear about this? Be very, this procedure, little bit, we will come out. This is not difficult. By practice, it will be easy. Incremental working capital, incremental non-current assets, and incremental replacement cost of the investments. Now, another concept. Okay, these are the things which free cash flow to equity. The free cash can only be calculated by taking the free cash flow. Okay, free cash flow. From the free cash flow, any interest we are paying, any deducted, any debt repayments are there, adding any cash from debt issue. Very simple. Okay, very simple. Minus interest, minus any repayments, and you are talking about anything we are going to add. Why we do this? That there is a reason, okay? Because this is the link, okay? This is the link. What is the reason? The reason is we are calculating to know the dividend capacity of the firm. Why we are the reason behind calculating the free cash flow to equity is the ability to pay dividends, because when they are talking about the dividend growth, the dividend expectation, dividend announcement, automatically link. This is the simple way of understanding the concept. Okay, when you are talking about the dividends, how it is going to influence the dividends. It is going to relate to the dividend. Then what will happen? Definitely we have to make it sure that it has to be free cash flow to equity. We have to work it out. Are you clear about this? Okay. Now they gave you the things. Okay. Read this one. Okay. Read this. This will add this will add a very good understanding, okay, very good understanding, and this will help more than anything else. This gives you a language of financial management. Okay, this will give, okay, that is not treated an investor is called FCF. It's called FCF. Is it? Read this one. Okay, read this. Just I'm leaving it to you. Okay, there can be variation in the definition when calculating free cash flow. See, you now there is the only thing what you have to remember, and I will remind you very clearly from time to time. Your framework has to be very, very strong. That's all. The understanding has to be strong. In between, the more you make assumptions, the more you make your ideas to incorporate. Is it right? It makes sense. Don't say that we don't have this information, how we can do. Usually, I have done, not a single question is there where we are supposed to take any extraordinary assumptions. Okay? Extraordinary assumptions. Only thing is as simple as that. If they don't give the risk-free rate, then you have to take the treasury rate. These are the simple things that you are going to expect from the question answers. If they are not given that growth, then we have to see what is the alternative. They will not give anything directly. It is a stepwise, multi-stage calculations will be there. Okay, only thing is you have to make a threading. However, when calculating free cash flow for a single year, it will be sensible to omit the change in the working capital. See, these are the assumptions. And discretionary non-maintenance capital spending. Is that because the ultimate payoff for those investment is not included in the operating cash flow. These are in simple way. I will write like this so that you will have when you do the things, you will have more focused. Okay, that is why we have written like this. These are the assumptions, or various assumptions are there. Growing the free cash flow, there can be variation like that. They in different situations it can be worked it out. See, growing free cash flow to are frequently and prelude to increase earnings, and hence may be positive sign for investors. These words you have to incorporate precisely. Conversely, a shrinking free cash flow may be indicator of problems ahead. And naturally, it is a fact and a sign that the company is unable to have a sustained earnings. Now, what we are assuming, what is the concept of free cash flow? We will see that when we are talking about the free cash flow, we will see that whether the company is going to grow, what is the trend, as simple as that. It is not something different. We will assess whether there is what is the future of the company. We will come with that. This may not always be the case. Many young companies put a lot of their cash into investment, which diminish the free cash flow. However, in this case, question might be raised about the sufficiency of short and long-term capital. New companies are there. Okay, new companies, they need more. No, they want to infuse more capital in the beginning. Is it? Definitely. You cannot make a judgment. Means you should know listed companies, non-listed companies. It has been started new. It has been established. Most of the time, they will not concern about established companies. If they do about established, see, if you are giving a scenario with respect to an established companies, okay, definitely when you come across established companies, there will be a financial distress. Financial issues will be there, and you have to give what are the reconstruction we are doing, how much we are going to do reconstruction, and how much you are going to make the things. That is the reason you should understand. You should have a very clear approach in which type of situation, how the things will work. Is that how the things will work? Is that they mention it? Read very quickly. Is it okay?
Yes, sir.
Okay. Understand, okay? Things, okay. They have given you the, see, they are giving you the cash flow, then they give you the free cash flow, okay? They give the free cash flow, and ultimately they will give the free cash flow to equity. Okay? This, fine? Now, when you are estimating how forecasting growth in estimated, we are talking about the historical growth, that we are talking about the analyst forecast, particularly for listed companies. Market regularly produce forecast for growth. And what is the fundamental analysis? Is it when you are doing the fundamental analysis, there will be a growth, is a retained earnings. Okay? How the growth will work, see the how much you are making the retain, how much you are having the retained earnings. This is what it says. Very simple, okay? Very simple. You will have profit after taxes, okay? The more, this is not a something, I'm not going to give anything new. I'm going to just I'm going to build whatever the knowledge you are having. I'm just going to consolidate that knowledge. Okay, you will pay the dividend. There will always be a, this is what the agency, one of the reasons of agency cost. Okay, and it will have multiple effects, impact. Okay, we will say that some people say that we will pay 20% dividend. Some people say 15%. Some people say 10%. Some companies will say that every year there will be a 10% growth. Some companies nowadays it is a very common phenomena. There is no dividend concept as such. Is it? There is no dividend concept as such. Only there is a capital gain. That's all. Why there is a concept of a capital gain? Because the investors are spread all over the world. Is it? You cannot convert, you cannot send it into their accounts, all those things. It's going to make that much difficult. Is that instead of that, what they will do? There is no concept, okay? There is no you will not find most of the multinational companies are paying dividends as such. National companies will pay, but multinational companies will not pay dividends. Automatically there will be a capital appreciation will be there. Okay, so when you do the things, okay, when you do the thing, there is a conflict. But what will happen if you are going to say 10% dividends? Okay, if you say 10% dividends, almost you are going to make a reinvestment of how much? 90%. The more the retained earnings is the more the reinvestment is there, the more the growth will be there. And it is proven practically by calculations and by assumptions also. So what is the Gordon's growth approximation model? Gordon growth approximation is the retained earnings, is it right, into the rate of growth, is it? What is the return on equity times in terms of the retention rate. Retention rate is nothing but the percentage of retained earnings. Is that percentage of the retained earnings? Alternatively, in an exam question, you may simply be told that which growth rate is applied. When applying any growth in the exam question, the rate used should be questioned, particularly if the figure seems high. Yeah, wherever they are giving you this type of supporting explanations which are related to exam, just make sure that we have to be focused. Okay, now have you done this?
Yeah.
Fine.
But sir, here you have confusion.
Tell me.
So sometimes for the free cash flow to equity, we deduct the debt, and sometimes we don't deduct that.
Where it has been given?
I think here this is deducted, but in other questions, maybe we will come through it.
No problem. No problem. Okay, no problem. It is not that much a big issue. Definitely, they have given some reason for that. Okay, that is the reason. Is that they have given some reason, or they have made some
I
assumption.
think I have seen one question where they mentioned that I think the debt level will remain as it is without any increase. So I don't know. Maybe this is the reason.
Definitely, if the debt level is remain the same, what is the formula for the free cash flow to equity? Any debt you have raised, then you have to add that one. If you are not raising the debt, if the debt level is constant, or it is assumed that there is no increase in debt, then they will not going to make any additions to that.
But eventually they have to repay the debt from this free cash flow to equity.
No, if there is no additionally debt is that why it is going to be, it is linked. See, yes, coming back to it, I'll just go back to that, okay? I'll just go go back to that, reconfirm you. Is it what is it? Adding any cash raised from debt issue. Adding, make it very clear. Is it adding this? If there is any cash, okay, if there is any debt we are raising, is it? If we are raising any additional debt in practical terms, fine. That's what it says. If you are adding any cash, you put in cash raised from debt issues. Is that if you see, we will not see because already we have raised the debt. Assume we have raised the debt in the year 2022. We are talking in terms of 2025. Is that already the debt raised in 22 has been incorporated in the calculations. But wait for a while. Give me particular situation, it will be more clear. Give me particular situation that we have a good reason to substantiate that that how you are going to work it out. Okay?
Yeah.
Now, I will give you the solution for that also. I will give the solution in the examination. Think you are in a little bit you clarity is less. That yes, immediately put it. Nothing will happen. Immediately put in the same way when you are doing even in the Excel sheet. Put one star mark. Put one star mark. Put an assumption. Put a star mark there and put a footnote. Make an assumption. This is on this basis we have taken this. The more you put the assumptions, relevant assumptions as necessary, I'm not saying the more, relevant assumptions as necessary, the more you will support your response. Okay, the more you support your response. Are you clear about this?
Yeah.
Okay, so the previous discounted fine. Alternative value of equity can be found directly by discounting free cash flow to equity at the cost of equity. Fine, free cash flow equity 1 plus G K minus G. The previous calculation found equity value by discounting free cash flow to present value of using the WC, then deducting debt value. This is known as fine. Okay. Alternatively, the value of equity can be found directly. Free cash flow to equity, value of equity. Okay. Okay, value of equity can be followed with this. Okay. Dividend valuation theory model. Yeah, dividend valuation model theory. Okay. Have you done this point by point? I'm asking you. Any doubts you will get at the moment you grow forward. We are talking from the basic. In the examination, they will not give like this. Don't expect that they will do. Okay. Have you done this each and everything? Yes or no?
Yeah.
Okay. You have. You have talking about the things. Is a little bit more careful. Okay. Little bit more careful when you are doing the things as that. Okay, first we have to calculate the free cash flow, then we have to calculate the free cash flow to equity. I'm just one second. Okay. Free cash flow to equity also, how you can calculate the one they have mentioned here. Is that free cash flow to equity? Value of the equity is, one second, where is that? Yeah, value of the equity is nothing but free cash flow, and discounting free cash flow to equity at the cost of equity assets. Make it clear, okay? Just because once I fine. Okay. Another one, is it right? This is what we are talking in terms of dividend model, dividend valuation model. The value of the share is the fine, okay. Fine, this is okay. This is 1 plus G, okay. We are not very deep. Is that this we are talking about in terms of the company just D1, okay, D0, okay, D0, 1 plus G, R minus G. Different options are there, options are there. There's no growth. Same thing, D by R. Okay, it is only the words will change. Okay, no growth, and they say that constant growth. Okay, and there is a constant dividend for a year, then growth forever. Okay, there is go for perpetuity. Three different situations. Okay, three different situations. Are you clear about this?
Yeah.
Have you done this? Test your understanding 3.
Yeah.
Okay. Constant dividends for 3 years and a growth for 4% per year to perpetuity. The model is highly sensitive to changes where growth is highly relative to the shareholders' required rate of return. The share price is volatile. Is that see? Now, when you are see, this is where we are working with the valuation process. Okay, this is where we are. Even a minor change in how much should be the growth. Okay, how we are expecting, how the shareholders expecting the growth. This is where the immediately any major decisions of the company's announcements, they will see the financial factors on the valuation purpose. Okay, whether if they are talking about the expansion, if they are talking about the diversification, if they are talking about the mergers, acquisitions, automatically one thing that always be there in mind is how if we are taking this type of decisions, how the growth is going to be expected. Okay, and it is a continuous factor. It is a very dynamic and continuous factor which is going to have impact on the valuation process. Slowly go. See, when I'm telling you, take the pencil. Okay, take the pencil out, keep the finger and just go each and every step, how it is linked. That is the most important thing. Is it? That is the most important thing. The moment even we are skipping one step, it matters a lot. Okay, and see the thing. Every way they are putting the assumption. We will not put this. See, we will try to avoid. Okay, we try to avoid assumptions to the extent possible, trying to grill down the scenario and get the extract from the given scenario. First thing, this is our policy, how we have to do. That we should not say that, oh, we have to take assumptions. Will no. First, we have to have a clear insight analysis. What are the information they have gained? In extreme cases, if things are not working, then we have to take assumptions. There is no hard and fast rule that they have to take assumptions everywhere. Okay. Now, here they have mentioned is that growth rate is dropping to 1.5, growth rate is increasing to 4.5. How it is going to have an impact on the value of the share. When you are writing the conclusion, the last part of your answer, okay, last part of the answer, you have to mention similar to this. I'm telling you similar to this. What it says, it since it's on, it is like a disclaimer. Understanding point, this is our policy, what we are doing from since beginning. We should not say that yes, this is the ultimate result is there. No, there are many other options are there. Is that it is not going to agree. The model does tend to match, tend to accurately match actual prices of the tend to accurately match. Is that we cannot say that it is actually this is the case, this is the solution. Okay, always there should be an open window has to be there, so that we should make it sure that something more can be worked out to have a more accurate results. Okay, now because dividend valuation model is not accurate, is that what we are doing? What is the alternative? The alternative is market-based methods. Is that market? Now you can understand. You should understand the perception of the things, how it is moving. They will not ask. They will ask. If they will ask only 2 marks for this, not more than that. Not more than. Why they say this? And even at this case, is it right? Even at this level, they will not ask you that also. Is that they will not, because already this has been tested in financial management. Already this concept has been tested in detail in financial management. Again, we are not going to make that. Okay, fine. You keep that for our understanding. Yes, for the small companies it will work. For the listed companies, we have to focus everywhere at any point of time. What are the treatments we are going for a listed companies? Is that this is the stock market value of the shares is the starting point of the valuation process. There is a perfect efficient market. Is that it not exist at all? But we have to. The share prices would be fair at all times. Reflect all information. This is the characteristics of the perfect market. In reality, share prices tend to reflect public available information. This is the reality. This is what the regulators in every country all over the world are really very principled on this. We have to, the confidence of the investors in the stock market has to be growing and it has to be retained. This is the way we can use this. Is that we can use these things in our explanation. That's what I am pointing out very clearly. Why this information is there? We can use, we have to use. I'm not saying we can, we have to use. Is it to add to support our argument? The market share price is suitable when purchasing a minority stake. However, a premium usually has to be paid above the current price in order to acquire a controlling interest. Is that? See the thing. And it is reality. Keep it in mind. Keep it in mind. It is reality. Very, 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 very specific. Usually, if you see, if you have 100%, okay, if you have 100, mark it at this one. Is that very realistically? It is 50%. Okay, you will say that I am going to buy only 10%. Fine, nobody is concerned about it. You will going to buy other 10. But if you want to buy more than 50%, the intention is you want control. When you want control, you will go some exceed control. You are paying for the control. When you are paying for the control, what will happen? You will pay some premium on that. If the value of the share is going to be $5, okay, you are buying how much? 5. But if you want to control and you want to acquire more than 50%, okay, more than percent, definitely what you will pay for any additional sale in order to cross that 50%, instead of paying 5, you will pay 6. Is it? You will pay 6. Now what is that? This is the, now when you are saying that, when we are doing the concept, say that why they have paid, you have to immediately match, rebalance. Okay, you have to rebalance. Why there is a additional, whatever, that is the reason you take into consideration the share capital and share premium. Yes, share. What is the concept of share premium? We are paying the share premium only to have what? You have to have a control. You have to acquire the controlling interest. All these things, wherever I am putting additional yellow with one, you have to be very focused on that. None other one. Is there one is there what? Market, stock market value. Okay. The second is the price earning method. Most commonly used, okay, most commonly used valuation method by the shareholders. Easily understood, most commonly. Is it? It is a very simple method of valuation, most commonly used in practice. Is that most commonly used in practice? Is that price earning ratio, market price divided by earning per share, okay? Earning share, market price divided by earning per share. Price, how many times, okay? How many times? Is that most commonly? Is it? We use that. From where what will get? We'll get the total equity value of the company. Total post-tax earnings times price earning ratio. It will be in times. It will be in times. Read this one very quickly. If you again, once we read it, once it is over, please tell.
Yes.
Okay. Okay, calculate the value of one ordinary shares. They have said the strengths and weakness of everywhere there will be limitations, there will be some advantages. Okay, there will be some limitation, there will be some axiom. They are now calculate the minimum value accept to and the maximum amount with ABC is considered. Have you done this?
Yeah.
Okay. They are talking about the range. Okay, they are talking about the range. How see now? It is little bit in advance. I am saying is that we always think it is a overpriced or it is a underpriced. Okay, there will be always be a corrections in the value of the shares. Yeah, there will always be a correction. That's what it says. We are only estimating how it is going to be the range with respect to the things. Another one, earnings yield method. Okay, earnings yield. What is the earnings? This is what it says. So now, whatever I will say, whatever we have done, that we have covered till now. Whatever you are doing, we are doing something new here. Okay, something new. Is it earnings? We have not done this. You have not done this previously in any of your courses. Okay, earnings yield. Okay, how you have to value the value of the company, total earnings divided by earning. First you have to calculate earnings yield and you have to substitute that. Okay, value of the company, that's very simple. Okay, value per share and understanding and interpretations. Okay, now this some deeper analysis is desirable. For example, examine the trend of share price over number of quarters in the light of the events such as profit warnings, acquisitions, okay, and the likely effect that they have had on earnings. You know, what are the things? It means we are not working on a even we will not work on a 12 months basis. What we will do? We will divide this on a quarterly basis. Okay, quarter. The stability, it means you should have consistency. That is the reason you see the thing. Most of the companies, what they will do? They will do quarter 1, quarter 2, quarter 3, and quarter 4 results. Why they want to? Why they will publish like this? They want to make it very clear that we are consistently growing quarter by quarter. Every company will not do this. Every other company will not do this. Okay, it is a cost. It involves the cost, but that's what it says. There, a deeper analysis is desirable. The stability earning is often important as it grows. That in general the market is observing new information to try to assess sustainable level of EPS. Means this is now you see the thing. You are just having a direct interaction with the market. Okay, the every 3 months there are changes. Okay, there are changes. Okay, how the company performance is responding to the changes. Okay, clearly effective growth is dependable on a stable base. That is why when we are talking about the stable base, we are talking in terms of fundamental analysis. This is all what we are doing is technical analysis. Okay, technical analysis. Okay, technical analysis. We are talking in terms of the movements of the share prices. Is it? And the trends of earning yields over time is to an extent a reflection of this factor. A prospective acquirer would of course be concerned, see the thing, would of course be concerned to assess the prospective target. Is it? On becoming part of the entity. Valuation is especially need to take into account the expectations of the target shareholders. You are investing. Think like this. You are making an investment. Okay? You are making an investment. When you are making investments, assume you are making an investment in a debt company. Nothing is there. Okay, where no growth. Is that when you say then no growth? Is that it is just it is there existing. But if you are acquiring that company, you will see what will be the growth in future. This is what the top level managers are doing. Is that you are not in at the basic level. You are at the higher level. When you are at the higher level, you will see. Yes, and as a matter of fact, when you are talking about the value of the company, is that when you are talking about the company value is not with us. We will never think what happens in the past. This is the financial perspective. We will not think what happened in the past. It is immaterial. We will not think what is happening current. It is also immaterial. We only think that what is going to happen in future. How we can take forward. That's the reason. Is that you take any acquisitions, you take any business, you are investing in the shares. You are investing in the shares. Then only you will understand the concept very clear. You will invest in the shares expecting that how that firm will be performed in future. What are their plans? What are their plans? How they are going to manage the risk factors? How are their sustainability? All these things you will cover. That is what it says. Is that when we are talking about the valuation is especially need to take into account the expectations of the target shareholders. This is where you are learning financial management. Okay, this is where you are learning the financial management as such. Okay, now you have another one. Okay, you have another one. They call it as a Tobin's Q. Read that one. Concepts should be very clear. This is part of the section A, and it will be multiple dimensions they will test. Okay, at the multi-level dimensions. Okay, this is not that like hedging or something where you will have a very specific steps. Just we have to go on some principles. This is where we are going to have our own inputs. Our own contribution matters more than what is there in the scenario. Okay, there is another method, market to book ratio. Okay, it is also first time you are doing. Okay, what they say, there are some problems are there. See, you should understand. I'm just giving a reference for you. Okay, you have a CAPM is there. Okay, this is more acknowledged, more acceptable. Is that you will have arbitrage pricing theory is there. It's only a substitute. It is a substitute. Likewise, you will have a NPV is there. You will have other methods are there. You have IRR is there. You have payback period is there. Discount. But most acceptable is NPV. But because we want to work on NPV, we will not going to say that we will ignore IRR those things. Likewise, there is another method we are talking about, the market to book ratio, book value to the target company assets. The ratio the market applies is not constant throughout its business cycle. So strictly the comparator should take only from other companies at the same stage. Definitely. Is it life of the company, age of the company? Is it that you all differs? Is that your financial base will always differ? There are so many things. You will have qualitative factors. You have quantitative factors whenever you are making a assessment. Okay, when you are making a comparison, you should have a qualitative factors, we cannot make a judgment. We cannot compare two companies at all at one platform. Are you clear about this? Slowly understand. Don't rush. Anything is there. I know where you will find where there is a possibility of having doubts. Is it okay?
Yeah.
Okay, they have done this, fine, okay. Now it is a assets, there are the market-based methods, there are asset-based. Is it? You in asset, it's very simple, is it right? Taking a starting point valuation of the financial asset. Book value, we will not take that much. Okay, we will not take that much. We will take mostly the market based, but there is an alternative, that is asset based. That you will have the replacement cost, you have the net realizable value. See, replacement cost are not easy to identify in practice. They are giving you a hints, okay, where we are working, where we are not working. This is the best part of the this book. That's what I say. They will give you the hints. We don't need to go anywhere. We are very exam focused. The replace is not easy. The business is more than just the sum of constituent parts. In fact, the value of the tangible assets in many business is minimal, since much of the value comes from intangible assets and goodwill. That is the what it's saying, is it right? Business is not money matters. Business is not that you are investing. Business is not how you are transforming the money into wealth. That is what financial management talks about. That is what the financial management talks about. There is a reason. People, what they will do, they will not what the banks are doing. Banks equity is how much? Maximum the own equity of any bank in any world is 5%. The bank strength is having the deposits. Okay, bank strength is having the deposit. The more the deposit, they are converting more into the loans. Is that is the reason. This happens not only in banks. That is the reason. What the major companies, the bigger companies as such, they will know how to take the loan and how to convert that loan into multiply that loan as such. Okay, so don't feel that yes the value of tangible assets in many businesses minimal. Okay, it's only the intangible assets that will work. Have you done this? Small problems, small things. It will be integrated into one big question as such. Okay, we are talking in terms of value of the share, and here also, if this estimate that the replacement cost of the one's non-current asset is 40 million. Intangible assets valuation method. Okay, now people are talking intangible. People are talking about service organizations. Okay, people are talking about service organizations. People are talking about with respect to the branding values. Okay, or asset that cannot be fine. That's okay. Fine. This is also a relation. Fine. The major flaw of basic asset valuation that it does not take into consideration the true value of intangibles. Now you will understand. Go back. Go back. Interlink the things. That is the reason. When we are talking about the intangible assets cannot be internally generated. Internally generated intangible asset will not be valued unless until it is going to be acquired. Okay, and you cannot proclaim, you cannot say that my value is this much. Others people has to recognize. Then only it makes things more clear. Okay, fine. The multiply is negotiated between the partners to compensate for goodwill. Okay, The simple formula provide two intangible valuations. Is there are two things. One is calculated intangible value and there is a Lewis method. Have a quick go through this, okay? Please. Is it okay?
Yeah.
It is based on the benchmarking the return on assets. Similar company of the same industry. It is calculated on value spread. Okay. It is related similar in size. Very difficult, is it? Similar in size, similar in structure. If no suitable similar can be identified, then we will take the average return may be used. Okay, fine. Company's operating profit ROA into company asset base. Unless until we don't do the things, we will not understand. Okay, this we don't know the things. This is see, if you ask me, I will tell you that it is very remotely. It is that much. It is hardly we have noticed this in not more than one or two questions really. Okay. Yes, once it is done, just give me 5 minutes time. I will tell you how it has to be done. I will let you know. Okay, where in the examination where we have to focus. Okay, maybe you have done that, but just I will revise it. It is on another file. Okay, they are talking about the fine. Okay, I am not taking that much time here. Okay, fine. Somewhere they have asked this. Okay, if I know the LEV's knowledge earning method, an alternative method of valuing intangible assets involves isolating the earnings to be related to intangible assets and capitalizing them. However, it is more complex than CIV, but it determines the return to intangibles and future growth assumptions. Right? This model does produce results that are compared to CIV. This has been used. This has been applied little bit on a higher side. This model does produce results that are close to actual traded price. This is a good valuation technique. It is there actually they have tested in one or two examinations. Okay, they are tested in one or two examinations. This is the variability in the earnings of the company whereas the financial risk is the additional volatility caused by the gearing structure. So if the merger or acquisition is with another company operating the same business, the underlying business risk of the acquirer will be unaffected. We have done this, is it right? In the previous case, re-gearing and gearing. Before acquisition and after acquisition. You remember?
Yeah.
Those formulas write down separately. Keep for quick reference. Okay, keep for quick reference. Done. Valuation of the debt. First you have to calculate the yield, then they have to discount with the yield. Okay, based on the rating. They will give you this, okay, they will see the thing. Paper company has 5-year bond, A rated company, risk-free rate is 2.5. The current table credit spread published by one of the agencies. The yield on the paper 5-year bond can be found relevant credit spread at the risk-free rate. It is A-rated company. It is A-rated company 5-year bond. Okay, it is A-rated company 5-year bond. If A-rated company 5-year bond, we have to take the specific value which is relevant to, which has been mentioned there. Okay, which has been mentioned there. That's all. Nothing is there. Okay, that is here they have given the big one. In most of the cases, they will give you this. Okay. They will give you a part of this in the section A, okay, section 1. Startup businesses. Last examination, they have asked one question, smaller one with that respect to startup, okay. If you are dealing, okay, see, I'm not saying if you are associated or if you are not associated, okay, keep it in mind whenever there is some interaction, some platform where people are talking about MSME or SME, okay, what are the problems they are associated. See, these are the areas we have. See, you will not come across a situation where company is doing good, they have good financials, is that they have good financial, they have doing perfectly good, there is a good future prospects. You will not, you will be, your knowledge, you cannot test your knowledge. Keep it in mind. You cannot test your knowledge when you are dealing with the best companies. Okay, you can learn from that. but you can learn, you can add value to that. But you can test your knowledge from when you deal with the companies which are running into losses, where you are transforming, is that where there is a transformation. That is the challenge you are going to take. That is why we are learning this subject. There should be a transformation, there should be a transition is there. Okay, there should be a transition, there should be a, we use the word re-engineering, is that we use the word re-engineering. That is where your talent, your skills, your knowledge comes into focus. How you are making a sick revival. That's what it says. There is a how you are part of a revival process. Okay, how you are part of a revival process. That is where you will gain a good experience. Okay, where you are getting a good experience. That is what it says. We are talking about SMEs. Is that we are talking about the sick units. Who will come to the bank? Who will come to the people who are really desperate? Is that they don't have, see, and they need to reorganize. And you are giving the loan based on some specific constraints you will give. Okay, only on some specific content. That is the reason we are we are studying this course. Very simple, very straightforward. They are often staff of inexperienced managers, unrealistic expectations. Okay, unrealistic expectations, future profit, a lack of past data makes predictions, future cash flows extremely difficult. You take from all the papers which you have covered, all the papers. Have you ever come across a situation where everything is good and they're asking you a response? No. In every situation there will be some deficiencies, there will be some shortcomings will be there, there will be some ethical problems will be there. Okay, there is some ethical problems there is some business strategy, there is something going wrong. You have to give a response where you can transform it in a more specific way. Estimating the growth, is it? Established companies fine, but startup companies, the more. This is what the current trends. Okay, this is what we are talking in terms of the current trend. What are the startups? Okay, how we have to give financial support, how you have to work out with the startups, and that's the most challenging one. That DCF models are problematic because of non-linear. Market-based models are difficult to apply. That cash is a key indicator of a startup process. You will have the problems with verbal. Here also you see the thing. They are not talking about anything. They are talking about the how you can. It is probably if share is valued. I will stop after 5 minutes. Okay. Read once. Okay. Read once all the things. Is that this one? It really makes things. Okay. You are going in detail. Okay, in detail. Is that what happens? Is that at peak value at the time of peak 60 billion, and the company was worth about 17 times of its earning and 6 times of book value. Major innovator. Business has a viable future. Okay, business has however, senior man unwilling to see excess valuation diminish. They communicate honestly with the market to reduce its expectation. They try to hide overvaluation by manipulating the financial statements, exaggerating the value of the new ventures. But the time the market has realized the extent of the problem, the core value has been destroyed. Read this one. Overvaluation means that there is a danger of paying too much for the target. Is it clear to you?